We're ready now for Chapter 15, and Chapter 15 is on leases. And if you have not already looked at the last page, which is in our previous module on our non-current liabilities, the one which is on installment purchases, you probably should review it. Because in leases, we are going to be questioning whether it is really a rental or it is an installment purchase. So we could have the same lease agreement with only slight differences, and one would be interpreted as if it's a purchase, and the other one we would interpret it as a rental. And so there's a dichotomy which happens in this chapter. You have to go either in one direction or the other, and in these two directions that you go in, your accounting will differ. There is also the perspective of the lessor and the lessee. So we have some terminology early on which you need to understand. So the pages before this in your module, it talks about the terminology. I'll be going back over the terminology today in this PowerPoint, but I also want you to go back and look at the terminology and be sure you're aware of it. In particular, the difference between the lessor and the lessee will become important because in the problem may ask you to do the accounting for the lessor. This is going to be totally different from the accounting for the lessee. So you need to be sure that you understand the terminology, because the terminology keeps coming up again and again. So leasing versus buying. So frequently a company will have to decide, are we going to lease the thing or are we going to buy the thing? And if you lease something and you lease something for a long period of time, it is almost as if you have bought the thing. And the thinking here is, if you have that situation, and I guess the way I also expressed it is to say that if you are the one who owns a thing that you're renting out to another person, to another party, will you have anything to rent once that renter gets done with it? Will you have anything left? And if you have nothing left, isn't that rental just like you had made an installment sale? Because you have the payments coming in and at the end you're done. I mean, you have no inventory item to rent out again because it's finished. It has no value. And that's the concept from the renter standpoint, from the owner standpoint, sorry. From the renter standpoint, it's that they have in effect used up the product without buying the product. They're making payments, okay? But in the end, they have nothing to show for it. There's nothing of value left when the rental is over. So in either case, we're talking about a product that is being leased out that really has no value at the end of the rental period. And so in accounting, we say substance. What is the substance of the thing? What does it look like? Does it look like it's really a sale? Or is it a rental? Because a rental, you would have some value at the end of that rent agreement period. So the financial statement advantages to renting are that if you are renting something, you would show an expense and you don't create a liability. However, if you're buying something, you would create a liability. You would show it as debt. So companies were trying to get away without showing liabilities by renting, but they were renting things for such a long period of time that really the substance of the thing was just like they were buying it. So under GAAP, it was decided that this is just not right. It's misleading. You have a commitment. You have a commitment because you signed a rental agreement. It's a legal document. You can't easily get out of it. And so when you go back and you talk about what is a liability, and we discussed that previously, you see there is a commitment. So why not call it then a liability? And this is the difficulty that you get into whenever you have accounting, and accounting is based on the bright lines concept. Then you will have companies that will create a situation so that the accounting will go one way to avoid recording the liability, when in effect it's almost the same thing as if they had made that installment purchase and should have recorded the liability. So you see, the problem you get into is that businesses were trying to play around with their financials and avoid recording liabilities by renting. And the individuals, a group of I don't want to say constituents that establish GAAP, and it is a political process, and I'm sure you're aware of that, said this doesn't fly anymore. It just doesn't. You're creating misleading financials by avoiding the recording of the liability. Sometimes this is called off balance sheet financing, and it's frowned upon because, again, it's misleading. It's misleading because there is a legal agreement, there is a commitment, but yet it doesn't show up in the liabilities. So what we need to do is we need to talk about what is a capital lease, and instead of saying capital lease, the terminology today is finance lease. However, they are pretty much still used interchangeably. Operating lease is a rental. It is a rental. So the one who is renting with an operating lease would call it rent expense. And the owner who is renting a product out under an operating lease would call it rental income or rental revenue. Whereas under a capital lease, you would consider that rental to be actually a sale and a purchase. And the criteria in 2 that determines whether you should record it as a sale, which is a capital or finance situation, or whether you should record it as a rental operating lease. What is the criteria for that? Previously, it was bright lines. Now it's more of a guidance or a principle-based approach. What is the accounting for a capital lease? This is very tricky. And how do sales leases without selling profit and sales leases with selling profit differ? So in 3, we are continuing to talk about a capital lease, which is a sale type arrangement. There's no real value left of the product after the lease term, and there can be 2 situations. It can be an inventory item which is being sold, in which you're going to have gross profit, plus you will have interest revenue because it is really a loan. And then there is the one without any profit, which is in the case where you are an owner of this capital asset, this PP&E item, property, plant, and equipment item that you have on your balance sheet, and you simply don't need it anymore. Rather than sell it, you can rent it out, and you can rent it out And if you rent it out in a certain situation where there's no value at the end of the rental term, you are to record it as a capital lease, as a finance lease. So that's what we're going to be talking about, learning objectives 1, 2, and 3. And when we work through our problems, you'll see that we will be returning back to that criteria in 2, because once you set the criteria, once you determine if it should fall under the capital finance or the operating, then it's going to tell you how you are going to put it in your financials, how you're going to record your journal entries. So we'll keep going back to that learning objective 2 with the criteria as we work through this. So the capital lease, or the other word is finance lease, are really purchases. Again, there's no value or very little value at the end, and that's really how we know that it should be handled, as if it were a sale transaction versus a rental transaction. And operating leases are rentals. The terminology: if you see E's, it's a renter. If you see O's, it's an owner. And then a capital lease, again, or finance lease, it is in substance a purchase or sale transaction because there's so little value left. Whereas an operating lease, it is just a permission to use an item. It says something about a liability here. Don't want you to get too much into that right now. We'll discuss it more. A short-term rental is something that is similar to your current, non-current terminology. It's a short period, and how did we define short is a year or less. Reassessment is when your terms of your lease change, and it may cause you to say that it was a capital lease and now it's an operating lease, or it was an operating lease and now it's a capital lease. So this is an area that is an additional complication, if you will, of lease accounting. Bargain purchase option or purchase option. A purchase option is when the renter has the option to actually outright buy the item. So you have heard this expression, rent to own. So think of it a rent to own situation. You can rent it, and if you decide that you really want to buy the thing, you want to own the thing, then you can switch from being a renter to a buyer at a certain point. Oftentimes these purchase options come at the very end of a lease term. So you get to rent it, or you sign an agreement to rent for 10 years, and at the end of the 10-year period, you can buy it. And if it's a bargain purchase option, you can buy it at a certain percentage of fair value, and it looks like a bargain, and you will probably do it. So a bargain purchase option is when you have, as a renter, the option to purchase. It could be during the rental period or at the end. Now, if it comes sometime in the beginning and you buy it, do you have to continue to make payments? No, because you own it. So you're going to stop making the payments. So you can see when we value this lease, if we have to make a present value calculation because we're recording that liability, well, it matters, because if you're going to buy it, you don't have to make the payments, so there's no present value of those payments. There is a present value of that amount that you're going to pay when you buy it, though, and that's a PV of 1, right? So I guess I should say along the lines here that when we're talking about leases, there are equal payments being made. These are the rental payments. The rental payments, when we talk about the rental payments, then these rental payments are really annuity type arrangements. And when we talk about present value, it's a present value of annuity. Whether it is a present value of annuity due or the present value of an ordinary annuity is determined by whether you have to make a payment up front or not. Sometimes when you rent things, the lessor, the one who is the owner of the property that's renting to you, is going to say, before you take this equipment away, I want you to make your first payment today. Well, if that's the case and you're making the payment today, that is an annuity due. However, if you get to wait till the end of the month or whatever it is, and whatever those periods are, month, quarter, year, and you get to wait till the end of that period to make your first payment, that is called an ordinary annuity. And most of what we do in this class will be annuity due. That is to say, you are required to make a down payment, and that amounts to being your first normal payment amount before you get to take that equipment home. So I cut off a bit of this. I'm very sorry. But this is very important. It's the criteria for determining whether you have a capital lease or an operating lease. So you either have a capital lease, which we also call as financing lease, or you have operating. And remember, the capital financing thing is going to be the same as an installment purchase. So, capital lease, any one of these 5 criteria, if any one of the 5 criteria is met, you will call it a capital or finance lease. And criteria 1 is transfer of ownership. So if there's a transfer of ownership, you are going to, in effect, say there's been a sale. Okay? So when you sign the lease, the true transfer of ownership may not happen until, say, 5 periods out or something. But if there's a presumption that that property is going to change hands and you sign a rental agreement, the presumption is that that is really a capital or finance lease. It's not a rental. It's really something that's more like an installment sale. And also then criteria 2 follows quite directly along with 1. It says the purchase option is likely to be exercised. So in 1, we are saying there's a definite transfer of ownership. There's a definite purchase that's going to happen, and we have it written down in it, and there's going to be a purchase made at a certain point. In 2, we are saying that the purchase is likely to happen. There's an option that the renter can exercise. And when I said bargain purchase option, my implication from using that, which is an old GAAP terminology, is that it really looks like if a person has, for example, the option to buy something at 50% of its value, it just seems to make sense that they would do that. Because if you buy something at 50% of its value, you can turn around and sell it. Whether you need it or not, you could sell it and make a profit. So under 2, there is the potential transfer of ownership that exists. And it looks like a reasonable person would be likely to do that. Under 3, the lease term is a major part or major part of the remaining economic life of the underlying asset's economic life. Oh Lord, that's a lot of words. What we're basically saying is the thing that's being rented, the equipment, let us say, is mostly used up. There's not much left of the thing. And by an expression of its usefulness or its value, might be to say that it doesn't put out output. Okay, so it may put out some output with this definition, but the major part of the output that's associated with this equipment in terms of its life has been used up. Again, we are talking about and looking at a thing that is so used up that at the end of the rental period, there's not much of value. Another way to look at the value situation is in criteria 4. And criteria 4 tells us that the total amount of the payments which are being made is equal to almost or all or even more than the fair value of that asset. And when we do this calculation, you don't total up the total amount of those rental payments and say, oh, the total value of these rentals is the same as the fair value when the rental agreement was signed. That's not what you're looking at. You're looking at the present value. So you need to present value all those rental payments and figure out how the present value of the rental payments compares to the fair value of that asset. And this is when the rental agreement is signed. That's 4. Now, the fifth thing which has been added here is because we recognize that sometimes there is a very specific asset that's created for another party, and there's a rental agreement associated with this asset. But at the end, the only thing we can do with that item or that property that's left at the end of the rental period is really scrap it because it's so specific in use. There is such a specialized nature associated with this thing that all we can do is scrap it. Okay. I have an example for you. Coca-Cola or a Pepsi bottling plant has a specific device that puts the caps on the bottles. Well, the caps will only fit on a particular shape of bottle, and the Coca-Cola bottle is a very specific shaped bottle, so the cap is a specific cap. If this machine was rented out and there was very little value to the machine except if it could be used for another Coca-Cola bottling plant, I guess, then you might meet criteria 5, in which case the machine itself has very little value because it's so specialized in nature. So when we look at this, what are we saying? Back up and look at the thing. Transfer of ownership occurs with 1 or 2. Criteria 1 or 2. So if you're transferring ownership, let's not call it rent. Let's call it a sale of a thing. And value, we're talking about value. Value at the end of the rental period applies to 3, 4, and 5. Right? These are ways of looking at value. So that is why we have the criteria. It does not have to meet all 5. It doesn't have to meet but one of those. And if it does not meet any of these 5, we will call it a rental. And the other word for that is operating lease. I haven't done very many slides, and it seems we've talked a long time already. So in our discussion of the criterion, I said, the new approach is not to use the bright lines. So the bright line approach was to say, use 75, use 90 here in the value. And so instead, the present value of the payments is substantially all the fair value. We would say is 90% or more of the fair value. And then when we say lease term is a major part of the economic life, we say the lease term is 75% or more of the economic life. And that's what we did, and those were bright lines. The change now is to get rid of the bright lines, which are rule-based, and to use principles. And so when we look at it, we say under 3 and under 4, we're gonna use 75% as guidance. We're gonna use 90% as guidance. So if we had a problem and we didn't get 90%, but we got 89%, or we got 88%, then we can argue. We can argue that since it is so close to 90%, we're going to call it a finance or a capital lease. Okay? So you get to argue your point using the guidance which says the numbers. Okay? Previously, we had to hit that mark exactly because that was the bright line concept, the rules concept. So here we go through and we look at this concept problem. Which of the following is not a sufficient criteria? So we had the 5 criteria, and which one of these does not meet that criteria? So I'll give you a moment to look it over and come up with what you think is the one which is not one of the 5. And this is the one that is not. Because when we look at the economic life, we said it should be the majority of the economic life. And when we look at economic life, one way of measuring economic life is the depreciable period of time. And so we tend to use depreciable period of time as a measure of economic life. 1/3 is not really the majority, is it? And if we really wanted to use guidance, we would use 75%. So if you did a problem and you got 67%, you would probably say that's not close enough to 75. Our guidance would be that it's not close enough. And here, 1/3 or 33 and 0.344, whatever, is not there. So that's the one that does not fit. Now, when you rent something and it is really a purchase, you know, if it were an outright purchase, you would record this asset on your books and you would call it property, plant, and equipment, and you would depreciate it, right? That's what we do when we buy things, and they are typically these leased items are property, plant, and equipment, long-term in nature, because that's what the lease tends to be. If we were buying it, we would have PP&E, we would record accumulated depreciation, so that at the end of a period of time, the asset would go away. And I refer this to as expensing of an asset, because you're really removing the asset from your books, and the systematic way to do it was accumulated depreciation. However, if you have a capital or a finance lease, you aren't buying the thing. In substance, it looks like a purchase, and that's why we're going to handle our accounting as if it was a purchase. But if you put it on your financials as a PP&E item, it looks like you own it. And technically, you don't own it. You are renting it. So legally, you're renting it. So it's wrong to call it an owned asset. So what we call it is a right to use asset. And when we put the right to use asset on our books, we need to take it off our books in some systematic way, because the value of that right to use asset goes down. Just as if we purchased something and it was PP&E and we record accumulated depreciation, we have to take this thing down in value too. And we call that amortization, not depreciation. And what we need to do is we need to, usually they use straight line, you need to take it off your books. Now, if there is going to be a transfer of ownership at some point, then we would do this amortization, and then we would switch over and we would call it depreciation at the point at which the thing is transferred. So what happens is you would be removing a right of use asset and putting the value in a PP&E account, and you would start taking depreciation. So if you have something that's transferring over, and here's the example. Mark Corporation enters into a 10-year capital lease. The equipment's life is 11 years. All right, well, 10/11ths, you can see right there that the economic life criterion is met because it's used up, right? There's expected to be no salvage value. If it calls for also a bargain purchase option or a transfer of ownership at 10 years, so at 10 years, which is at the very end of this lease arrangement, and by the way, that's another criteria met that tells us it's a capital or finance lease. Then when this ownership happens, then this Mark Corporation is going to put it on their books, and it's going to be PP&E, and at that point you're going to continue to take the value of the asset away. So what should we do when we talk about this amortization? And I put in parens at the top, depreciation. Well, what you should do is you should amortize it as if it had a lease term which exists all the way out for its economic life. In other words, you should take $10,000 a year and you should amortize that, and you're going to do that for the 10 years, right? And that would be $100,000. And then you're left with $10,000. And what do you do with the 10,000? You take depreciation in the last year of its economic life. Because at that point, you're going to be buying it. So you're going to buy it at 10 years, then you're going to depreciate it for the next year. And the proper amount for you to amortize is to amortize that as if its total period of time is the 11 years. So that's 10,000 a year. Now, what if there was no transfer and it still met the criteria that it is to be called a capital or finance lease? What happens then? If it still meets the criteria and you have no notion that there's going to be a transfer, no bargain purchase option, nothing that says there'll be a transfer, what should you do? You should use up the total value in the 10-year period of time. So therefore, that's the bottom line. You should amortize $11,000 a year. So this is just another little twist in leases, particularly those that are finance and not operating. There is also interest. There is interest when you have a capital or finance lease, and there is not interest when you have the rental. And I will be a little more specific about it. You'll see what we're talking about later, but in general, let's say for now that if you're talking about a capital lease, you have interest. And this is the interest that comes in to the owner. Okay, so I'm going to be specific. It's the owner's interest. Okay, the owner who is really financing the buyer's purchase because at the end there's not going to be much of a product left. There's nothing left for the owner to rent out. When we have something like this, the owner will get interest. It will be interest revenue. And that interest revenue, like all other items that are showing up in our income statement, has to be under the accrual method, so we have to show it as an amount that has accrued. Now, a little discussion here about annuities. I already talked a little about this. Typically, in this chapter, I would like for you to use annuity due tables because most of them, almost all the problems which I have, are going to be payments which are called for at the beginning of the lease, or an upfront payment, or I sometimes refer to that as a down payment. Before the renter leaves with the equipment, they have to make a payment. This is annuity due. When you get into your smart book and you start working through your smart book, some of those will be due and some of them are likely to be ordinary annuities. You need to be sure to use the proper ones and to know the distinctions. So when we were in our previous chapter and we did the interest came at the end and we were using the ordinary annuity. In this juncture, if the payment is in the beginning and not at the end, again, you're going to use the due. So there tend to be different, you could use different present value tables depending on leases and installment sales. If your installment sale requires you to just make a payment at the end, then you're going to be an ordinary one. However, with a lease, you may see it due at the beginning, and the due at the beginning would be annuity due. So you may end up using different tables depending upon the situation. This is a problem here where we ask you to determine whether it meets the criteria. One of the first things you need to do is to say who's the lessor and who's the lessee. Sans serif is the one who is leasing. They are the leasee. And first lease is the lessor. And here you have the lessor who purchased the equipment from someone else at a cost of $479,079. I'm going to assume that they just purchased it. So the lessor just purchased this thing for $479,079, and then they're going to lease it out to the lessee, who is sans serif, and they're going to have to make 6 payments. But notice here that the payment begins on January 1st, 2018. They say the beginning. They didn't even have to say the beginning, because you recognize what they're saying in this on the very first line. They're trying to tell us that the term really is starting on January 1st. And so they make the payment on January 1st, and then they say they make a payment on December 31st at the end of the year. Well, an astute person's going to say that's not 365 days, that's 364 days. For purposes in this class, like in the previous chapter, if we say December 31st, just call that January 1st. Basically, they're saying you're going to make 6 annual payments, and the first one begins at the beginning, and then you're going to go out and you're going to make a payment at the very beginning of the next year as well. So you're paying at the beginning, and this is not an ordinary annuity, but right, an annuity due. They say the price that they pay for the right to control the use is the present value. So basically 100% of the present value of the lease payments is equal to the fair value of the asset. I'm just going to give that one to you. The interest rate that we need to use is going to be given for us, and it's 10%. So how do we do this? How do we apply the criteria? You may want to go back and forth to the problem and read it over as we go through these. The present value of the lease payments is an annuity due. NIN is 6 because there are 6 payment periods, and the interest rate is 10%. You take the number of the payments times the present value factor to get the present value. I want to caution you here, you cannot go from present value to future value tables in the same way that you could when you do PV of 1. In most instances, I will give you the payments. Your smart book and also your quiz that you'll be working in Connect. Be careful as you work through them. I think by the time you get to the quiz at the end, you'll have no difficulty. But initially, as you work through it, pay attention to the way in which they calculate the present values in this. Now, I'm looking at this, and the present value is 479079, and I recall seeing that number on the previous slide as the value that the lessor paid when they actually got that equipment on their books. So I have to say that, that's right. That's 100% right there. And so I know just looking at this slide alone, one of the criteria is met, and I'm going to have to call it a capital or finance lease. I'm going to have to, which means in substance, it is an installment sale. And for the other party, it is an installment purchase. Okay? So, is there anything in there? Again, I said you might have to go back to the other one that says that ownership transfers. No. Is there something, and I call it a BPO, a bargain purchase option? They're saying reasonably certain a purchase option would be used. And then the lease term, if we went back and we said it goes 6 years and it has a 6-year life, that's 100%. My guidance on this, again, is 75%. And 100% is definitely more than 75, no question about it, so that one is met. The fourth one we just discussed, it is met. And we didn't even have to do 100%. The guidance was 90%. And there's no discussion of future use. It says, do they have no alternative future use? And I don't see any discussion. So if there's no discussion, then you can't really use the fifth criteria. The fifth criteria only comes into play if you can look at the thing and it says there's no other use for this thing. And if they make a statement like that in a problem, then you can look at 5. Otherwise, you really don't have anything to go on to make the classification, so it's usually not a part of your problem. So you just had to meet 1, and we met 2 there. Now, what happens? What happens in the journal entries? Because I said capital leases it's gonna affect how you do your journal entries. And also notice here, you have journal entries for the lessee, the one who is renting, and the lessor, the one who is owning. Well, the one who is renting needs to record not an asset, but a right of use asset. So they're not going to call it a PP&E asset. It's called a right of use asset. And then they are going to record a lease payable. Now the lease payable is going to be the present value calculation for 6 years. Going back to what we had in the previous chapter, we said the amount which is within the next year needs to be classified as current. The amount which is outside that year is non-current. So at this point in time, you would look at this and you could come up with an amount of that 479,079 that's going to be current and an amount that's going to be non-current. We don't need to do it now. We do it when we do our financials. And then the lease payable right away. This is the exact same day. Remember I said the renter is not even going to be able to leave the showroom with the thing unless they make a payment. So they turn right around and they pay $100,000, which is the payment amount, their first payment up front, and I often refer to it as down payment. It's an upfront payment of $100,000, and they make it the same day. And someone's going to look at this and say, Well, why don't we just, the lease payable recorded at 379,079, and then let's put the cash credit for 100,000, and then let's record the right of use asset for 479,079. Why don't we do that in one journal entry? And I'm going to tell you, when you start using this and you start creating your amortization tables, then it's much easier if you do it this way than another way. When you look over here to the lessor, the one who is lending out this equipment, they no longer have the equipment on their books. They are forced to remove that equipment from their books. If they remove the equipment from their books, can they take depreciation? And the answer is no. They no longer can take depreciation on the asset. They're going to remove it. This is a bit simplified because when you remove a PP&E item, you need to remove the PP&E item, you need to remove the accumulated depreciation, you need to record a gain or loss, and you would be recording cash coming in. In this instance, they are recording a lease receivable. And I want you to start thinking about a lease receivable a little bit like an account receivable. It's a receivable. It's a right to receive some money in the future. So, in the long form of this, if they'd given us the accumulated depreciation, we would have recorded that in this journal entry. We would have credited the PP&E specific item here. We would have recorded either a loss as a debit or a gain as a credit, and we would put this lease receivable on our books. This is a simplification, okay? It's a simplification. So the gain or loss gets recorded and gets put on the books today. It's not spread out over the future. It gets recorded today. And then the next thing that happens the same day is after they sign the rental agreement, technically that's this journal entry, then they give you a check. And when they give you a check, it's this. So again, yes, you could have combined all those together. What I want you to see here is that these things are really mirrors of each other: receivables and payables, cash coming in, cash going out, an asset being removed, a right of use asset going on the books. Can you see how they are mirroring each other? One is the standing of the one who is renting, the lessee. The one is the standing of the owner, the lessor. And I guess you can see now why I was driving home the need for you to really understand what lessee means and lessor means, because if we ask you journal entries, these are clearly different depending on whether you're looking at the lessee or the lessor. You've got to keep it straight. Now, as time passes, what's going to happen here is a period of time has passed, and when the period of time passes, there will be a portion of that payment which is going to be interest for the period of time, and a portion which is a payment of the principal, or a paying down of the payable, or to the one who is receiving the payment, the lessor, it is going to be interest revenue. Okay? How do you calculate this interest revenue or the interest expense? And it is the outstanding balance at the beginning of the time period times market rate. It's the same thing. In this case, we don't have the market rate. We would say it's the reasonable rate. And it's the rate which is given to you in your problems. And an assumption of your problems is that the rates which are given you are reasonable. There's more detail about that, and you'll get that when you go through your SMART book. Now, if this is off the books, the asset is off the books of the owner, there is no depreciation taken. Now, the asset is showing up on the lessee's books, but it is not showing up as a PP&E item because they don't own it. is it called the right to use asset. We need to remove the right to use asset and record amortization expense. And this is done just like you would record depreciation. So if a month passes, you'd need to record a month of amortization. And it has to do with whenever you do the financials. Before you do the financials, we have to record amortization expense. We have to accrue this thing. We have to show this thing. And it needs to be done periodically, which means we need to show, get it up to date before we do our financials. Now, it is okay if you want to say accumulated amortization right to use asset and accumulate it that way. Or it's okay if you want to just credit the right to use asset to reduce its value. The point here we're doing is we need to reduce the right to use asset. If we anticipate a transfer of ownership to the lessee at a point in time, then you go back to the rules we talked about, and your amortization needs to be such that you have some value in your right to use asset, because you need to change it when you actually own the thing and call it a PP&E. If, in the other hand, you are not going to transfer it over, and it's just going to go back to the lessor at the end. It's going to be worthless, basically, but it's going to go back to them at the end. Then you want to make sure that your right to use asset becomes 0 at the very end. So your total amortization needs to be spread equally among the periods, and that's why we call that straight line. It's usually straight line done for these capital leases. Now we're going to look a little bit at a table because it's important for you to know the table. Sometimes I say 0, 0, 1, 2, 3, 4, 5. Now when we looked at this, we said it was 6 periods, right? But technically, the interest is only for 5 periods because the first one came at the beginning. Now, if this and this is the same day, which it really technically is, the only way you can have interest if there's a passage of time. So between this line and this line, it's the exact same day. You are leaving the showroom. This is the day you came into the showroom and you signed the lease. This is the day in which you leave the showroom. I don't believe you're going to stay in the showroom for any period of time. You're going to come in the showroom, you're going to sign the lease, we're going to record the lease right here, and then you're going to cut a check and you're going to make your payment, and when you make your payment, then the amount you owe goes down by $100,000. There's no passage of time, so there can be no interest component. So I said this is the beginning of period 1. I wanted to bring it home that this is also 0. It's the same day as this. So when we look at this, you are still going to use the 6 when you do your calculations, because an annuity due takes into account that first period is really at the beginning of a time period. So the interest periods is really 5, but when we do our present value calculations, it's 6. A little confusing, isn't it? So what I see students doing often is they go here and they're used to doing their tables, which we had for our non-current liabilities in the previous chapter, and we looked at the initial balance, and we took the initial balance and we multiplied that times the interest rate to come up with the amount of interest here, and we would have put that there. And that's not what we do, because this is really a 0, okay? And at the beginning of this time period is that day. That is the beginning. There's nothing to go back to calculate. Now, this number is easy in this because we have a 10% rate. You can see This is the same thing you've been doing, and we know how to do this. We've done this before. This is interest expense or interest revenue, and we can see how it's calculated on the beginning period's balance. The difference between the total payment and the interest is going to be the amount which would apply either to our lease payable or our lease receivable. And in the first instance, there's no passage of time, there's no interest, so therefore the total amount of the payment in its entirety reduces the lease payable. I have lease payable here. You are going to do an identical one to this, only instead of lease payable, we would call this a lease receivable. So this same amortization table will apply to both. One party is going to call it interest revenue, the other is going to call it interest expense. One is going to be reducing the lease payable, the other one is going to be reducing the lease receivable, and that's what's in this column here. The other point I drove home earlier is that when we look at this amortization table, we want to have nothing left at the end. So in the far right column, it's the lease payable or the lease receivable. We want to have zero left. You can see our present value calculations in this particular one cause us to have a little bit of a difference. So you are going to make an adjustment, and the adjustment will be between interest expense and the reduction in this case of lease payable, or it's going to be interest revenue and the reduction in the lease receivable. You're going to fudge your numbers a little bit. You cannot adjust, just like we had in our previous chapter on non-current liabilities. You cannot adjust the cash amount. The cash is $100,000. The cash coming into one party is $100,000, going out from another party is $100,000. We can't change that. So the difference gets adjusted in here so that the total amount of the lease payable gets removed, and this becomes zero. So you would go in there then and you would pick up the numbers and you would do the journal entries. This is the second payment. And I could go into the table and I could show where that is, and I could say, you know, if the interest rate is 10%, then what must have been the lease receivable at the beginning of this time period? And you would say, well, it looks like it's $379,079, doesn't it? So that, you know, you can see that. And they mirror each other, and it's wonderful when they mirror each other. A finance lease, or also called a capital lease, they're asking for which one of these meets the criteria. And so read through these. Look at this. Lease term is 8 years and the asset life is 9 years. 8/9. That's pretty big. On D, 70%. And I said you have some guidance. So use your guidance when you look at this. And it says here they're going to be buying it at a fair value plus 10%. And I'm not going to tell you again whether a purchase option is likely to be exercised or not. I'm going to say, does it make sense? Would someone pay fair value plus 10%? Why would you pay more than fair value? See, that one you throw out automatically. Okay, so I think you've probably come up with the right solution, and yes, it's C, because 8/9 again is going to be greater than our guidance, which is 75%. And it goes down here and talks about it and shows those. Another one, interest expense. This is a tricky one. The present value is 40.5 million. And you're going to make 6 million in payments, and you are going to start at the beginning and make your 6 million in payments. They want to know what is the total amount of interest expense December, and these are making annual payments. So when you look at this, you're going to figure there's 6 months, I believe. Don't be tricked by this, because you have July, August, September, October, November, December. That's 6 months. And don't look at it and say that's the end of July and then start counting at August. So it's a payment up front, and you're gonna make the calculation, and if they want to know what should they record as interest expense for 6 months. And it seems that if you're recording a liability, it would just does not seem right that there will be zero. So you can throw out zero automatically. And how you calculate it is you're going to be looking at your amortization table, and you're going to see that your first one is going to be paid, and all of it's going to pay down the balance basically the day you signed it, right? You wrote the check. So the 6 goes off the top, and then the total interest which you are going to have for that whole year is going to be 10% of the difference between 40.5 and 6. What is that? That is what 33.5 million. 10% of 33.5 is 3.35 million, and then you are going to take half of that, and I guess you get 1.725. So it's a tricky one because some of you would have taken 10% of this number and not subtract this, but it's a payment in the front, which is a trick. There's one last thing we need to talk about here. One last thing in this chapter, or this part 1 of this module to talk about, and that is when you have profit and when you don't have profit. And what we're talking about in selling profit is that there's a difference between this item being held in inventory versus the item being an item which is PP&E. If the owner, the lessor, has a PP&E item, there may be some gain or loss. We talked about that. So if they're holding it, and there's what we call no selling profit, also sometimes called direct financing. These are both capital or financing leases. If they're holding it as PP&E, they need to take the equipment off their books. They need to take the accumulated depreciation off their books. They need to record a gain or loss. And they need to record the lease receivable. And the lease receivable is the present value of the stream of payments that's going to come into the company that's associated with that lease. And you know the next journal entry is going to be where we receive in the cash before they leave the showroom. That's usually what happens. And in this, it says no selling profit, as selling as in an inventory item. There can be profit, there can be gain or loss associated with taking that equipment off the books, but it's not a selling profit. In this other situation, we are removing the equipment, and the equipment is being held in our inventory. And when we hold it in inventory, you know, you credit inventory, you debit cost of goods sold. So that's what they do. And they are also then going to record a sale. Instead of having an account receivable, we record it as a lease receivable. So if you could just back up a minute and think about a situation where a retailer sells a product and they record account receivable. This is the same thing here. This journal entry is exactly the same, except it's not account receivable, it's lease receivable. Why would you want to do it as a lease receivable versus an account receivable? An account receivable is short term, and this is longer term. If it's longer term, we want to be paid interest, don't we? So you would not do an account receivable long term. You would do a lease receivable long term because you want that interest. You want the interest. And so basically, it's just the same. It's the same as an accounts receivable from this journal entry, except you change it to lease receivable. And the thing that happens that's different in the future off of this lease receivable is you get interest revenue, which is a marvelous thing. Otherwise, you would just have an account receivable. So when you have this situation and you have selling profit, you recognize the profit as being the difference between the sales revenue and cost of goods sold, and that is the owner, the lessor. And again, the other benefit, if you show it this way instead of showing it as an accounts receivable, is you show interest revenue. Now, one of the things that's my pet peeve while we're talking about this is sometimes people call it interest income. The definition of income is revenue minus expenses. Is it proper for the lessor to say we have interest income? No, they should be calling it interest revenue. And I think you may see some problems and they'll call it interest income. You may see it some places, even on the CPA exam, I've seen it called interest income. It's not interest income, it's interest revenue. So here we have a problem, the same problem we had before. I'm not going to go through the calculations. The only difference here is instead of taking the thing off their books at 479079, they actually made this equipment and they are going to sell what they have manufactured. And for a manufacturing company, it's called finished goods. So they're getting rid of their finished goods inventory and they're recording sales. It's exactly the same thing as if this manufacturer had done it as an accounts receivable sale transaction, except with this situation, we are going to get interest revenue over that lease term, which is much better than recording it as an account receivable. And the important numbers have been done here in red and bold for us. And so after we determine it's a capital or finance lease, we say, is it a sale of inventory or is it our PP&E? So that's the determination of which it is, and that determines how you do that initial journal entry if you're the lessor. And so what they would do is they would record revenue, and notice here that the sales revenue number is the present value because that is the proper value of the sales transaction. It is the present value because the future value would include also interest. And we need to go back and we need to look at the present value of the streams and record that as what our sale amount is. The other part that is in the total amount, if you were to look at the total amount of the payments, the other part of it is interest. And it is more proper, is right for us to record our interest as being earned over the rental period and not at the beginning. It's earned over the rental period in a systematic fashion. Okay, and it's accrual accounting that we do that. So this is a journal entry. Should be fairly easy for you to know this right now, right? And after this journal entry, basically everything is the same because we are still going to go into it. And the next thing that's going to happen actually on the same day, January 1st, 2018, is our lease receivable is going to go down and we're going to get a check in for $100,000. That doesn't change. The amortization table, it stays the same. We're going to continue doing everything the same. Just the point to drive home is that you have selling profit. You do not spread the selling profit over the lease term. You consider it a sale. The sale happened on this date, and the financing of the sale is through the lease agreement. And that's the theory behind the thing. So here's the next one. No interest on that first one, right? So it's precisely the same as my point to bring home. And the thing is, if it's the lessee does not care about selling profit. I mean, from a business standpoint, maybe they do. Maybe they care if they're being taken to the cleaners and paying too much for the thing they're buying under a lease. But as far as their accounting goes, it doesn't matter. You're going to put the right of use asset on your books, and it's going to go on your books at the present value of the rental payments. So it really doesn't matter to them. The only thing matters is to the lessor. And if there's profit, record the profit at the beginning. That's the point. Here we have they want us to tell what the total increase in earnings is for mills. And you're going to say, well, who is the lessor and who's the lessee? And it's all in the way it's phrased. So mill is leasing, mill leased. So they are the owner, the lessor, and Jim is the lessee. And it gives you the present value, and it tells you that the payment is due up front. So it's a due situation. And in this, they also have a cost. And the cost of the thing is $750. So this thing is going to be cost of goods sold at $750,000, and the thing is going to be sold at the present value of the minimum lease payments discounted, and that's 810. So you can pick out the numbers and you can see automatically that there's going to be profit and there's going to be sales profit there on the thing from 60,000. You can see that. And that is on top of anything, which is, now here we go again, interest income, should be interest revenue. It's on top of the interest revenue. And in the first period of time, they're not really financing the whole $810,000 because they're making a $120,000 payment right on the first day. So we're really financing the net of the 810 and the 120, and then you take the percentage because it's a accrual basis. You get the 94.5. So I think you can work through that. This one, leasing farm equipment sales type lease, you can work through this. 33 million is the cost, 40.5 is sales. Sales minus cost of goods sold. That's a part of the revenue flow. They didn't ask us for the total amount. The other question was total pre-tax effect, right? This is asking us just interest revenue. Thank you for using the word revenue. So you need to go in here and take the 40.5 and you need to subtract out one payment. It's an upfront payment, and then you need to calculate the time, how many months have passed, and it's starting July, so I guess it's going to be a 6/12. Then you're going to use your 10%. And how do we get the number? There we go. So I think you get it now. The next thing we're going to be talking about is operating leases.